Welcome to the Operational Leaders Podcast, where we discuss the business of running an investment management business with your host and top industry executive, Terrence J. O'Malley. This podcast is proudly sponsored by Diligence Vault, the fintech platform designed to transform, streamline, and automate the due diligence experience. Diligence Vault solves the outdated and inefficient diligence and data collection processes via its digital platform, a solution that's even more important in today's remote working environment. The Diligence Vault platform is built specifically for manager research, ODD, compliance, and ESG teams. And Diligence Vault counts over 20,000 global users, including its strategic investor Goldman Sachs and other industry leaders like NEPC, Wells Fargo, USS, and Utimco. Join the Vault today at diligencevault.com.
My next guest has over 20 years of experience on Wall Street, leading an alternative asset investment firm that forms, grows, holds interest in, and raises investor capital for alternative investment funds. He's an active member of the alternative fund community, having served in various director positions for industry associations, supported numerous philanthropical causes, and is a frequent speaker at alternative fund conferences. He's the managing director of Crawford Ventures. Please welcome Evan Katz.
Well, hey, Terry, thanks very much. Great to be here with you, and thanks for having me.
Hey, it's great to have you here today. Can you tell us a little bit more about Crawford Ventures?
Sure, happy to do so. Brief 10-second overview. I'm a native New Yorker, grew up on Long Island, went to Wharton, was a finance major there, ended up going to law school, actually, at Harvard, coincidentally in the same class as Michelle Obama, small world. But after practicing law for a bit, have been on Wall Street for about 15 years. And what Crawford Ventures does is it principally is in the alternative investment space, hedge funds, private equity funds, venture capital funds. And we help build them, raise a lot of investor capital for them, and help them with whatever operational, compliance, legal, regulatory needs that they have, team building and so forth. What I think we're known for without question globally the most is fundraising, given our investor base and investor relationships.
So Evan, I think everybody's got a great story when they come on and they tell us about how they got involved in the business. Well, how'd you get involved in the business?
Absolutely, positively, not the way most people got involved in the business. First, I am what they call a recovering lawyer. And most recovering lawyers who end up in the investment business, almost all of them were corporate attorneys, working at a hedge fund or a private equity fund or something like that. I was actually an intellectual property attorney back when no one even knew what that was. But I think most people now know patents, trademarks, copyrights, internet, computer law, and so forth. And the way I actually got into the hedge fund and alternative business was I actually raised a lot of capital for, of all things, several presidential campaigns, several United States federal presidential campaigns, raised a lot of money for them, and also raised a lot of money for some friends who had companies, mostly in life sciences and in technology, and discovered that even though I was a practicing lawyer, an IP lawyer, I was actually really good at raising capital, knew a lot of ultra high net worth family office types, endowments, foundations, and sort of just fell into it after doing the presidential campaigns and raising a lot of money for friends' companies and taking one in the public. I had a buddy who was at a hedge fund, and he said, Evan, a ton of investors, you're really good at fundraising, and I never really thought about it. So I ended up starting to work with him, and as the old expression and as the old cliche says, the rest is history, and here we are 15, 20 years later, having spent almost 24 years raising capital for alternative funds, hedge, venture, and private equity funds. So kind of fell into it.
And so that was back 15, 20 years ago, you started Crawford Ventures.
Correct. Yeah, roughly around then. Exactly. I was one of the founders of Crawford. Correct.
And then going strong ever since then.
Most days, yes. Far more up days than down days, but most days, yes. It's been a remarkable journey for someone who started off being an intellectual property lawyer, ended up spending about 6 or 7 years on the Hedge Fund Association board of directors, speaking at a ton of conferences in the press. And to be quite honest, I love the industry. Some of the brightest people on Wall Street are in the hedge fund and alternative investment space. Some incredibly bright investors, endowments, foundations, pensions, you name it. Some terrific fund managers, and also getting a chance to truly see some extraordinary investment talent, everything from traditional long short equity fundamentals bottoms up research to a ton of quant funds, artificial intelligence, machine learning, vol-arb, stat-arb, activist funds. So it's been very interesting. I have a bit of a computer background, which I normally gloss over because it doesn't have much to do with long-short equity usually. But in terms of quant funds, and we see a ton of them in machine learning and AI, I used to be a contributing editor of a computer magazine, personal computing magazine. So truly appreciate the incredible technology that's being brought to bear in many, but by no means all hedge funds. So it's been a real interesting opportunity to bring to bear sort of deep knowledge of finance, investors, investing, fundraising, and when there are quant funds, a lot of technology as well.
Let me get back to you in a few minutes on some of the trends that you're seeing in the business. But real quick, couple of rewarding days in the business, couple of challenging days in the business. What stands out for you over your 20 years?
Sure. Well, rewarding days for a fundraiser and a fund builder are the days that investors make the huge allocation, whatever the amount is or could be. Most of our investors typically do about $10 to $100 million per investor per fund. Some will do $100 to $250 million per investor per fund. So, if you ask any PM, his or her most rewarding days are the days or the years that he or she was up a ton, or, hey, the decade they were up a ton, the case may be. For a fundraiser, it's the first meeting went well, the second meeting went well, the third meeting went well, and then the huge allocation comes in. Those are definitely the best days. And obviously, the numbers in the hedge fund business can be extraordinary when people write ticket sizes that are $200 million, quite frequently. And I still remember seeing some of those numbers on paper for the first time saying, wow, actually help bring that in. Challenging times, obviously there was the financial crisis where everything was quite challenging unless you were a short biased fund. And I knew some that were and did great. Obviously the financial crisis was an extraordinary time. You had venerable names like Lehman Brothers going under, where if a year before you said Lehman Brothers would go under, they would have had your head examined. And only very few people in the industry saw it and shorted Lehman, and, they made a killing on it. But the financial crisis was challenging. Not only did a lot of funds have issues, some of the service providers had issues, people lost their jobs. So from a financial level, a Wall Street level, and just a fundamental human level, Bear Stearns going under, just absolutely mind-blowing. Obviously more recently, a little thing called COVID, which has been horrific. Millions of people around the world have lost their lives. We have friends and family who've lost family members. People have lost jobs. But obviously in the alternative investment arena and the hedge fund arena, fortunately, during a horrific global pandemic, the overwhelming majority of us have been working from home. So clearly 2020, March, April, and May were sort of nothing going on, people just trying to figure out how to survive and what to do and where to get N99 or N95 masks. But for the last year after that, we've been doing more investor calls and more investor Zooms than ever. It used to be where out of the 1,000 allocators we know, out of maybe give or take about 40% are in the tri-state area, and the rest a couple hundred miles around there. But it used to be in order to have a couple of dozen meetings with investors, if you were a fundraiser like me or a PM, you had to wait for the quarterly cap intro event, wait for the quarterly conference in Florida during the winter, which a lot of people love to fly to, and all this sort of thing. So the insane part, one of the many insane parts of COVID is that after the first couple of months, when every person became a Zoom jockey and learned how to do virtual backgrounds and everybody pivoted, you then had a situation where instead of only being able to meet with investors quarterly or once or twice a year, if they were in New York, if they were in California, Chicago, London, Hong Kong, China, all over the world, it became a situation where if you were a fund manager or a fundraiser like me and you wanted to meet with an investor and that investor wanted to meet with you, you'd be on a Zoom in a couple of days having a a face-to-face, not in person, but a face-to-face meeting with you and your team and the investors. And we went in the industry from, a situation where if you asked an allocator, would you ever give $50 or $100 million or more to a manager you never met? If you asked them that question in January, February 2020, they'd say you were crazy, out of your mind. Of course not. But then here we are a year later where a lot of allocators have written some very big checks to managers they've never met in person. Yes, they may do more due diligence and they probably should, and so forth and so on. But in a lot of cases, the investors have known me for, most of my relationships go back 10, 15 years. They've known me for a dozen years or more, or they know part of the team. So it's really been a real pivot and a real reset of what does it take to get the ball started. Now, I think, once COVID is completely over, God willing soon, everyone will be back doing face-to-face. And I don't think managers are going to get $250 million checks having never met an allocator. But the notion of Zoom and technology being able to expedite things is going to be tremendous. So I think on the front end, the capital formation, the transactions are going to be vastly expedited by people being able to get in Zoom 1, 2, and 3 and accomplish a tremendous amount with the virtual data rooms and everything, and then basically get things teed up first in goal on the 10-yard line to mix sports metaphors. But that's what we're seeing now. The world has never been able to do more fundraising than they have because of Zoom during COVID.
So let me ask you, so that sort of has made it a more convenient exercise in some ways, that people can meet up, not so much in person as they did previously, but there's so much technology that's available to do that. Has that impacted the actual environment, the ability to raise money, the ease with which somebody might be able to raise money industry-wide?
Well, I think it depends. Well, there's a good lawyerly answer. Recovering lawyer always says it depends, but the truth is it does depend. I think it depends upon how many people in your team, or how does or does not your team and your fundraiser know a ton of investors already. If you are the truly emerging manager, and most are, most emerging managers have been doing this for 5, 15 years. They're just at a fund under whatever the number is these days, a couple $100 million. But if you are a true emerging manager, Billy Bob, Susie Q, who just graduated B school and thinks they're going to be the next Jim Simons or Ray Dalio, it is going to be insanely difficult for you to raise capital without being able to go meeting investors face to face initially to get them to take your call in the first place. I mean, that's sort of either the best kept secret or the worst kept secret on Wall Street. A lot of times people just will buy a list from somebody and email blast an investor list and wonder why no one reads their emails or responds, or extremely few. The truth is that investors get hundreds or thousands of pitches every single year, most of them. So the question is, if they get an email or a call from someone they don't even know, will they return it? Probably not. I mean, we've done studies on this. I mean, we've had situations where managers rented a list, bought a list, email people, call people, and the number of hits that we will get, because we have relationships going back 15 or 20 years, is orders of magnitude greater. So again, to answer your question, Terry, if you're truly an emerging manager starting out and you don't know already hundreds of investors on a first-name basis for more than a decade, it's going to be extremely challenging. Most of the capital formation, the investments have gone to funds where the investors at least know one or two members of the team for 5, 10, 15 years, or one member of the team and their fundraiser, or some combination thereof. Or, of course, the classic case where one of the best people on Wall Street spins out of Brevin Howard or Bridgewater or Izzy or Stevie or something like that and is a known quantity. But otherwise, it's going to be very difficult. In fact, to your point, people have often asked me, how do I know 1,000 institutional investors and family office allocators? How did I ever get to know them? The joke answer is one at a time. That's true. But how did I do that? Basically, by going to conferences. I've actually, I think at last count, have gone to over 1,000 hedge fund and investor conferences in more than a decade. Now, obviously, at this point, I've been doing this 15 years. I've cut back tremendously. But the way I got to know $6 or $7 trillion of capital initially was for the first 10 years going to every single conference around New York, the tri-state area, fly where you have to. But of course, during COVID, that was brought to a complete standstill. So the best practice point is, yes, if you've got some people on your team who know what they're doing and know investors, you can raise money. Absolutely. If you have nobody on your team, it's even more crucial to make sure that your fundraiser is somebody who's been doing this a long time, has a little gray hair or no hair, and already has those relationships intact.
Well, let me ask you, are we oversimplifying this business a little bit? I mean, can we think about it as one monolithic enterprise? Or some people have suggested you've got a lot of big name firms on the one end, you've got emerging managers in the other, and maybe not much in between. How do you think about the industry?
Yeah, I mean, there definitely can be a bit of a barbell, or what the statisticians call bimodal, if I remember my statistics correctly. And, it is the proverbial often the 80-20 rule, maybe the 90-10 rule. But as I say, 80% of hedge funds or alternative investment managers are under whatever the magic number is these days, 500 million, maybe even 250. 10 or 20% are multi-billion-dollar funds, and there is this real barbell going on. The irony is going back to something that the famous late, great Senator Daniel Patrick Moynihan said, his most famous quote, "Everyone's entitled to their own opinion, but not their own facts." Well, what are the facts? The facts actually are, we've done research this over about 10 to 15 years, All the studies show that even with survivorship bias and everything else, emerging managers in the hedge fund space tend to outperform, on average, of course not every one, they tend to outperform their larger, more established brethren and the female versions thereof by about 1 to 300 basis points a year. And 1 to 300 basis points a year is a lot, especially compounded over 5, 10, or 15 years. And those are the facts, even with survivorship bias taken out and everything else. So the question is always, the biggest complaint I get from hedge fund managers, I've got the world's greatest track record. I've been putting up 20 to 40% a year or more for 5 or 10 years, and I can't break through $50 or $100 million, can't reach critical mass, or one of my favorite expressions is escape velocity. And, this has been talked about a lot in the press, and, frankly, the true reason is that most of the larger allocators, or more accurately, the people working for them, are stuck with a bit of a conflict of interest. And this has been discussed many times. If you are Johnny or Susie helping to run the big endowment, the foundation, the pension, if you do great, you get a pat on the back and maybe a slightly bigger raise or bonus. But if you invest in an emerging manager, that something happens, you get blamed, you're out of a job. Whereas if you invest in one of the huge managers who's down 30% one year, well, you invested in so-and-so, and so-and-so was down, and so was everybody, all the other big funds, and everyone else invested so-and-so too. And there's a real disconnect there. So that does continue, and there are some ways of getting out of it. I mean, that's one thing I've emphasized in some of the videos and PowerPoints I've done.
Yeah, you've talked about that. Why don't you give us a couple of tips there? I mean, one of the things I think you said is think about who you approach. If the big allocators aren't going to give you the money, there's other potential investors as well.
So Terry, you bring up an interesting point about emerging managers, and I cannot tell you how many high-performing, high-quality emerging managers we know and have worked with that were putting up tremendous numbers year in, year out, better than virtually every other fund on the planet, but could never break the $50, $100 million AUM level and could never achieve what I call escape velocity. And there are 2 points that I can't emphasize enough, and 99% of them never do. The first thing is make sure you hire close, if not full-time, the best fundraiser that money can buy. And a lot of emerging managers try to outsource everything. They outsource the CFO. They outsource trading. They outsource fundraising. They outsource everything. And then they are surprised when they don't get the allocations. And if you consider an investor who's looking at 2 funds, everything else being equal, one has outsourced everything, including compliance, including a CFO and operations. The other one has it internally. Where is the allocation going to go? Obviously to the latter fund, the one that has all of those professionals internally. Similarly, a lot of the young emerging managers hire a ton of marketers to email blast their fund to everybody and wonder why it doesn't work. The trick is basically invest in your business. Invest in your business to hire a real CFO who's going to be working for you, if not full-time, most of it. Hire a top fundraiser who's going to be working for you, if not full-time, most of it. And shockingly, you will do a lot better than if you outsource everything and spread yourself very thin. Now, 2 other points come up is make sure that your fundraiser knows the emerging manager investors. Out of the 1,000 allocators that we work with, that we have relationships with going on about 10 to 15 years, about 200 of them specialize in emerging managers or otherwise are open to investing in emerging managers. And like we said before, the most important part of sales is fishing in the right pond. And that's critical. And if you have that match of your fundraiser with the investors you're trying to get in front of and pitch, you will raise massively more capital in massively less time than if you are simply email blasting to some list that somebody gave you.
Yeah, and sometimes it comes down to the little details as well. And you've given some great advice, really practical advice. What are some of the 2 or 3 things that you would tell people? Always get this straight. There's no excuse not to get this right.
Sure. Well, the first thing is, before I forget, is take a look at our website, crawfordventures.com. About halfway down the page are 2 links. One is to a PowerPoint presentation called How Hedge Funds and Alternative Investment Funds, Private Equity, and the like can raise money from institutional investors and family offices. The original title was Raising Capital Successfully from A to Z, and it had, no surprisingly, 26 tips and tricks for how to do so. And that was about 8 years ago. We've been revising this now pretty much every year for the past 8 years, and A to Z is now, if I recall, triple C or something like that. It's 50 some tips and tricks and practices on how to raise capital. It's actually become the industry, the alternative investment industry and hedge fund gold standard. In many respects, it's been downloaded thousands of times. And I've been told by people they have used it to raise billions of dollars of capital. And of course, me being a fundraiser has said, hey, where's my piece of that? I should have gotten some kind of commission from every fund that's used my PowerPoint to raise the first 500 million, the first billion, the second billion, whatever it is. But it is free. It is on our website, crawfordventures.com, about halfway down. There's also a video link right next to it where you can watch my presentation of that at the Penn and the Harvard Club from late last year.
All right, so you've got great materials there. I don't want to dissuade people from going. Can you give us a sneak peek, 2 or 3 points that are really fun that people will enjoy reading about?
Sure. Well, a lot of it I'll leave to the PowerPoint, but 1 or 2 things I will leave you. Probably the most 1 or 2 important things that most funds never do, especially in the emerging manager space. And that is either commit operating capital or raise it yourself. Okay, what in the world am I talking about? So Terry, if you and I are going to we're going to build the world's greatest French restaurant or Italian restaurant. Now, bear in mind, most of those lose money, but let's say we're going to do it. We've got to put up a couple of $1 million. We have a budget. We build the restaurant, and God willing, we have the next Le Bernardin or what have you. The great thing about the hedge fund business is you can start it with 2 guys, a gal, a dog, and a Bloomberg for virtually very little money. That's the great thing. You can get to first base in hedge fund jail really easily. That's the good part. The bad part is it takes a lot more to get to second, third, and home. So I've seen countless emerging managers set up a fund, get to first base, and discover they have no operating capital to hire the CFO, to hire the marketer. And they outsource everything, and they wonder why they can't build their fund. And some of them say, well, I don't have $3 to $5 million to put at risk. And I say, okay, if you don't, that's fine. So go to the 4S. Go to the 4S, your friends, your family, your former investors, your former colleagues who know you for 5, 10, 20 years or longer, and who know what a great PM you are and your strategy, your investment is world class, and say to them, I will sell you 20% of my firm for $5 million, whatever the number is. And if that gets you the operating capital to then bootstrap your way to hire a real trader, a real CFO, the best fundraiser money can buy, someone like me, or there's other people who do what I do as well, that then solves the chicken and egg situation where you don't have the money to hire the people to get the investors. And it is probably the number one thing that emerging managers never think of, or they think of and don't want to do, because a lot of them end up in this trap where they don't want to give up 1% of equity in their fund. They want to be the sole owner 100%. So they will go spend the next 10, 20 years, maybe their entire career, owning 100% of a $20 million fund instead of 70, 80, 85% of a $1 billion fund. And it makes absolutely no sense, but some would rather part with their firstborn than give up 1% of equity, even if that will enable them to get to the 50, 250, and then the $1 billion mark. Let me put it very simply. Jeff Bezos and Steve Jobs and Bill Gates did not become billionaires because they own 100% of Microsoft or Apple or Amazon. They became billionaires because they sold equity, raised capital, built a business, and now they own whatever the number is, 20, 30% of a multi-trillion-dollar company. So that is probably the number one piece of advice I can give to a hedge fund manager, especially at the emerging manager stage. Make sure you've got the operating capital to build the business where someone like me can bring in $1 billion or $2 billion. And if you don't have it, go to your friends and family with your hat out, raise a couple $1 million so you can then do it right. Otherwise, we get calls from people who spend 10, 20 years in sub-$100 million AUM purgatory, and they never get out of it.
All right, so that's one. You're going to give us a second?
The second one is something I think I should probably trademark the phrase, do reverse founders class. What in the world is reverse founders class? Well, founders class, as everybody knows, is when an emerging manager is desperate for assets and they will give away the farm and work for barely any fees just to get money in the door and say they've got AUM. And as one manager once jokingly said to me, maybe I should pay the investors to run their money for them. And everyone does founders class and so forth, except for one problem. Founders class makes absolutely positively no sense, and every manager is wrong for doing it, and every lawyer is wrong for setting it up, and every accountant's wrong for suggesting it. Okay, now I've got to back up what I just said with some facts. How come everybody's wrong, and why does founders class make no sense? The reason it makes no sense, Terry, is when you're a growing fund, you need the 2 and 20 or whatever it is, 1.5 and 20 to build your firm. If you are giving away the farm and working for 1% and 10% to get assets in the door, you will not have the ability to attract talent. I'm not going to come work with you. Top CFOs aren't going to leave a great job and come work with you because you don't have stability as an operating capital, as an operating business. So a phrase that I coined, reverse founders class, is what many of my investors will do, and I suggest it to a lot of them. And that is, they will pay 2 and 20 day one. They'll write the 50, 100 million, 200 million, $250 million check day one, and they'll pay 2 and 20. And they want you, Mr. or Mrs. PM, to grow your business and to have people in risk and to have a compliance group. But they will put in their contract that when you hit 250, 500, 750, a billion, the 2% goes down. Because let's face it, the 2% was when the 2 and 20 model and the 2% match, if you were in hedge funds, were a couple of $100 million. And if you were 500, you were a big hedge fund. Those days have long since gone. So reverse founders class says, get the 2 and 20 day one. Your investors will pay it when you point out to them, or when I point out to them, that will help you build a business, get talent, which is in everybody's interest. And you'll give them the fee break when you hit 250, 500, 750 million. And that makes a lot more sense because you can't attract talent to build a business if you're working on fumes because no one's going to come join you. I won't, and other top people won't either.
Hey, Evan, terrific information today. Really a lot to think about, really some great insights. You mentioned your website earlier. Can you repeat that for us? And where else can people find you if they want to look for you?
Sure. The company, again, is Crawford Ventures. So the website, no surprise, is www.crawfordventures.com. Again, download the PowerPoint there. There's a lot of content. Watch the video. If anybody is interested, they can certainly email me. The email, as is usually the case, Katz, EKATZ, at crawfordventures.com. First initial, last name at crawfordventures.com. And one last thing, if I may say, the pandemic has caused a lot of people to reevaluate priorities, to thank God for the blessings they've got and realize what's important and what's not. For those people in this industry who do make very large sums of money, and a lot of them do, also consider hedge funds care. I've been on the Committee of Hearts for Hedge Funds Care, Help for Children, formerly known as Hedge Funds Care. You may know the group. They're one of the top Wall Street philanthropies, one of the top hedge fund charities. Every year, we raise many millions of dollars to give to world-class organizations that help fight, prevent, and treat child abuse. Pretty much, I don't think you can find a top Wall Street firm or top hedge fund firm that is not very actively involved in hedge funds care, HFC, or Help for Children, or doesn't have a lot of people involved. The annual gala raised many millions of dollars. It's been temporarily, has not been in person, obviously, because of COVID. We look forward, God willing, to getting back to that in person. And like we say at Crawford and a lot of other people say in the industry, look, I've worked with Mets fans and Yankees fans, and they've had a great debate over that. I've worked with Republicans and Democrats. We can debate that. But nobody is for child abuse. 100% of people are against it. So for those who can step up, go to just Google Hedge Funds Care, Help for Children, just Google it. And if you can make a contribution, the vetting process is extensive. We really give great money to great organizations that do tremendous work fighting child abuse, preventing child abuse, and treating children who unfortunately have been the victims of it. So I will leave it perhaps with that.
Thanks, Evan. That's a terrific message. Help for Children. Really great work you do there. Thank you very much. And thank you again for coming on today.
No, Terry, it's been my absolute pleasure. Hope people have learned something and look forward to being in touch with some of your listeners if we can be of any help to them.
Thank you once again to our sponsor, Diligence Vault. The firm's easy-to-use platform has digitized the research and due diligence process for thousands. For all of your manager and fund diligence needs, check out diligencevault.com.